You ever see one of those stock charts that's just covered in lines and numbers and weird patterns, and you just think, what am I even looking at? Well, today we're going to take one of those charts and treat it like a map. We're going to figure out how to read the story it's trying to tell.
Okay, so here it is. At first glance, I know, it looks like a total mess, right? You've got waves, you've got lines, you've got numbers all over the place. But stick with me. We're going to break this whole thing down, piece by piece, until every single mark on here makes sense.
Now, before we really dive in, let's get one thing straight. The goal here is not to predict the future, and this is definitely not financial advice. What we're doing is learning the language that analysts use. We're trying to get our heads around the story they are trying to tell with a forecast like this.
You've got to think of this chart as just one person's hypothesis, basically an educated guess based on patterns they've seen in the past. You know, technical analysis is just one tool in a giant toolbox. And here's the kicker. You could give this same chart to two different analysts, and they might come back with two totally different stories.
So where do you even begin trying to find a pattern in what looks like total chaos? Well, a lot of analysts start with something called Elliott wave theory. It's kind of like they're looking for the rhythm, the choreography, and the seemingly random dance of the market. The core idea is actually pretty simple. It suggests that the up and down movements of the market aren't just random noise. Instead, they follow these repeating, predictable patterns that look like waves. The whole game for the analyst is to figure out, okay, where are we right now inside that pattern? And if you look back at our chart, you can see this theory in action. See those big numbers? The analyst has labeled what they believe are 5 distinct movements. 1, 2, 3, 4, and a potential wave 5. That's what they see as the main long-term direction of the stock. And this whole 5-step dance really breaks down into 2 basic moves. First, you've got your impulse waves. That's waves 1, 3, and 5. These are the big, powerful engines driving the price in the main direction. Think of a huge wave crashing onto the beach. Then you have the corrective waves. That's 2 and 4. These are the smaller pullbacks, kind of like the water getting sucked back out to sea before the next big one hits. Okay, so the idea of waves makes sense, and this is the big question, right? How on earth does an analyst even begin to guess where these waves might stop and start? Well, that brings us to the next tool in their kit. To do that, they need a way to measure these waves and project potential targets. And for that, they turn to a mathematical sequence that's found all over the place in nature. It's pretty wild, actually. They use something called Fibonacci ratios. You see all those horizontal red and black lines drawn across the chart? Those are Fibonacci levels. Analysts use them to map out potential zones where the price might hit a wall and turn around. You can think of them as invisible tripwires that a ton of traders are all watching at the same time.
Honestly, the easiest way to think about these is just floors and ceilings. A support level acts like a floor. It's a price point where buyers tend to show up and hopefully stop the price from falling any further. And resistance is the ceiling. It's a price level where sellers might take over and make it really tough for the price to punch through and go higher.
So we have the waves telling us the direction, and we have Fibonacci levels giving us potential targets. But there's one more crucial piece to the puzzle: momentum. I mean, how much oomph is really behind a price move? For that, analysts use another indicator. It's called the Relative Strength Index, or RSI for short. Just think of it like a momentum meter for the stock. It bounces between 0 and 100, and it tries to tell an analyst if the price is moving too high, too fast, which they call overbought, or if it's falling too low, too fast, that's oversold. And see that jagged little line at the very bottom of the chart? That's the RSI. An analyst uses this to basically fact-check their wave theory. For example, during a really strong wave 3, they'd want to see a big peak in the RSI. It's another piece of evidence to support their story. All right, we've talked about the 3 key ingredients here: the Elliott waves, the Fibonacci levels, and the RSI indicator. So now let's put it all together and finally read the story that this analyst is telling us with this chart. So what's the bottom line here? The analyst's hypothesis goes something like this. First, a big, powerful upward move, wave 3. Looks like it's finished. Second, the stock is now in a pullback or a correction. That's wave 4. Third, those Fibonacci levels we talked about are highlighting a potential floor where this pullback might finally stop. And lastly, if that floor holds, the theory suggests there could be one more big push upward to start wave 5. So let's look at the whole chart one more time. It doesn't seem quite so random and chaotic now,
does it? You can actually see the potential story taking shape. The Elliott waves give us the main plot. The Fibonacci levels mark the key turning points, and the RSI is down there confirming the story's momentum. It all clicks together to form one single, coherent idea.
And this brings us to one last big question. When you have millions of traders all over the world looking at the exact same charts, the same wave patterns, and the same Fibonacci levels, do these things work because there's some kind of natural law of the market? Or do they work just because everyone believes they're going to work? Something to think about.